Hi, my name is Tyrosh Gomez, and it's going to be the presentation for case 10, and our group is group 5. And I'm going to be presenting for question number 1. So just to reread the question really quick, it's what are the advantages and disadvantages of going public? And does our group agree with Billy's concerns, or do you concur with other members of the Goodman family regarding the issuance of an IPO? So Billy was stating earlier in the case that making the company public is going to have a negative effect on it, and they will inevitably lose control of their company and what goes on there, and it'll be more in the hands of investors. And he preferred them just going more overseas and having manufacturing over there in order to save on costs so that they can have more cash at hand. So I listed some advantages and disadvantages of both. The advantages are to raise capital by selling shares, more liquidity, debt reduction, exit opportunities. And some of the disadvantages are potential loss of control of company, which is Billy's biggest concern, pressure from investors, and additional regulation requirements. And our overall evaluation of the whole situation is both concerns are entirely valid, though, as stated earlier, Wayne is nearing 75 years old. Making the company public can help reduce unnecessary stress on the owner while allowing the company to continue to grow. Furthermore, with the amount of new products being released and strain being felt on different facilities, raising cash quick can help expand new productions. So basically, we're stating that the company should consider going public.
Hello, my name is Brian Sanchez, and I'm going to be presenting question 2. So to start off, the question was to comment on Kelly's preference of the corporate value model, and based on that approach, what would Orange Bright's selling price per share be if they were to issue 30 million shares? So a reason that Kelly prefers to use the corporate value model for a private company is because it uses discounting of future cash flows at an appropriate discount rate to measure the overall value of a firm. Since it's a private company, we don't have the normal data such as like the price of the share, the beta, any dividends that they issued, or earnings per share that we can go ahead and use in order to calculate that. So the earnings before income taxes, we went ahead and just used what was given. So 95,296,875. Our tax rate was 40%. And then our net operating profit after tax was 57,178,125. And we got that by doing earnings before income tax minus the tax rate. And we have our change in fixed assets, which was 26,604 with 850. And then for our free cash flow for 2015, we got 30,573,275. And we calculated that by doing the net operating profit after tax minus the change in fixed assets. And our expected growth rate of free cash flows for year 1 was 20%, year 2 is 10%, and year 3 was 6%. Our risk-free rate is 4%, while our market risk premium was 8%. Our beta was 1.22%, which we did this by averaging the 3 competitors' betas. And our required rate of return on equity was 13.733%. And we got that by doing the risk-free rate plus the market risk premium multiplied by the beta. And our cost of debt was 14%, and our after-tax cost of debt was 8.4%. We got our after-tax cost of debt by doing the cost of debt multiplied by the tax rate. And right here we have our debt, our equity, and these are the weights that we were able to get. So for the debt, we got 35.97% weight, and equity weight was 64.03. And for our weighted average cost of capital, we got 11.81%. And the way we got that was we went ahead and multiplied the after-tax cost of debt multiplied by the debt weight of 35.97. And we added that with the required rate of return on equity multiplied by the equity weight. And so to continue on that, so we calculated our free cash flows for 2016, 17, and 18. So for 2016, we got 36,687,930, And the way we calculated that was we multiplied 2015's free cash flow by the expected growth rate of the cash flows, which was 1.20. And for 2017, for that free cash flow, we did the same thing, except this time we used the 2016 free cash flows, multiplied that again by the expected growth rate of the cash flows, which was 1.10. And then for our present value, we added the FCF in 2017 with the FCF in 2018, and that's how we got our present value. For FCF in 2018, we calculated a little bit differently. So that one, what we did was we did the 2017 free cash flow multiplied by the expected growth rate of the cash flows, and then went ahead and divided it by our weighted average cost of capital subtracted by the expected growth rate for year 3. So for the firm value in 2015, we got 653,514,694. And the way we calculated that was we used the formula net present value in Excel, and we used the weighted average cost of capital as our rate. And the two values that we used was the free cash flow in 2016 right here, and we used the free cash flow in 2017, this number right here. And that's how we got firm value in 2015. Our debt was provided, and for equity value, we got 600,139,694. And the way we got that was we did the firm value minus the debt. So we got firm value minus debt, and that's how we were able to determine equity value. And the number of shares was given. So they wanted to issue 30 million shares. And so based on that, we were able to determine that if they would issue 30 million shares, their price per share would be $20. And in here, we went ahead and displayed our Excel formulas. That way you can kind of track on how we calculated and got those numbers.
Hello, this is Hunter Thompson. I'm going to be covering question 3. Question 3 asks, it's a comparison to Kelly's price estimate. We're going to use Billy's price estimate, which is based on the price ratio model. And then what are the pros and cons to this approach? So you see here, these are the ratios for 3 different companies. And then we see the price for earnings, price for book, price for sales, and price for cash flow. And we use that to get the averages. Then step by step, you get the current level, the compound growth, which we get from our income statement and balance sheet. 1 year ahead projected level, end of year estimated value, and then we get the estimated value today, and then we can use that to get our price per share going off of 30 million shares. To get a little bit deeper, we'll go into the formula for one of them. So like I said here, you will see the average from these 3 numbers to get our price per earnings. And then we get our current level and our compound growth. We get that from our income statement. And then we use that, the current level, and multiply it by 1 plus the growth rate, which will get us our 1 year ahead projected level, which we then multiply again by this average we found earlier, which will give us our end of year estimated value. And then we use that and we'll multiply 1 plus the required rate that will go that'll be on the next slide, which will get us our estimated value today. And then we'll get that number and divide it by the 30 million shares, which will get us our price per share. And just to look again, so we use these for price per shares, and that's going to get us our average price per share, like we see here. So we see the beta, the risk-free rate, the premium, and the required rate, like I was talking about. We get these 3 from the work from question 2, and we have our number of shares to be issued. And like I said, we get our estimated price per share, which we get from that average of these 4 numbers on the right here. So as you can see, we get our estimated price per share of $46.92, and then the total value of equity would be right here. And so pros and cons, the pros for the ratio model, it doesn't matter like how big or small the numbers are. You can use a ratio and you can compare that with other companies in the industry, as well as you can compare them with, you can use them as like a trend analysis. You can compare those ratios with past years and look at how the ratios have either been staying steady, inclining, or declining. A couple of cons though, it uses historical data like we know. to try and help us forecast for the future. But it can't always take into things like economy changes, like inflation, for example. And then ratios can also be affected by accounting methods. So depending on, say, if a company uses first in, first out, first in, last out, this could affect like inventory levels and different ratios like that. And so accounting methods always has to be taken into account when looking at different ratios.
Hello, my name is Carter Haro, and I'm going to be going over question 4. Question 4 reads, how far off would Joey's price estimate be if he were to use a three-stage approach, which growth assumptions of 30% for the first 3 years, followed by 20% for the next 2, and a long-term growth of 6% thereafter? We are to assume that the firm pays a dividend of $1.50 per share at the end of the first year. So first off, we have our periods on the very left, periods 1, 2, 3, 4, 5, and 6, with the changing growth rate as said in the question, with the 30, 20, and 6. As we can see here, we do get the dividend growth on the dividends during non-constant growth phase. And then at that very last, we do have the price of the end of the non-constant growth, which is going to be through a different formula, which I'm going to show after this. As said in the question, our dividend in year 0 is $1.50. The required rate is 13.73. And then once we bring all of this back to time 0 using the NPV formula, we get that the intrinsic value is $44.95. As we can see here, we have the formulas for each of the formulas used. For our dividends during non-constant growth, we get the dividend in year 0, and we multiply it by 1 plus the growth rate. And then we get each of the subsequent years for when we continue on. For the price at the end of the non-constant growth rate, we do get the that year plus the 1 plus the 6%. And then we are going to divide that by the required rate minus the growth rate to get that price at end of non-constant growth phase. All in all, we do get that NPV formula, like I said before. And our rate for that is going to be a required rate, which is 13.73. And then we do just input each of the dividend non-constant growth values. And then at the very end, we get that last dividend non-constant growth phase value, and we add it to the end of the non-constant growth phase, giving us our total, like I said before, of $44.95. Thank you.
Hello, my name is Luis Medina, part of Group 5. For question 5, it asks, based on the 3 estimates provided by Kelly, Billy, and Joey, how much per share do you think that Orange Bright is worth? It is worth noting that all 3 have used different valuation models that gave out different results. Billy and Joey's estimates were the 2 closest at $46.92 and $44.95. They both used Billy used the price ratio model, and Joey used the dividend discount model. On the other hand, Kelly's estimate had a higher difference between the other 2. Kelly's estimate was of $20 and used the corporate value model. Since all 3 valuations were differing, we decided to find the average of all 3 valuations. When we did so, we found that the average valuation was of $37.29. For that reason, we evaluate the Orange Bright's price per share of $37 with $37.29.